Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, August 5th, 2019. It is 10:49 Eastern Time as I'm starting this video, so we're a little more than an hour into trading, and I wanted to do an update. Just go over the key levels. I put out some levels today on the 60-minute charts and then on the daily charts. Remember, daily charts are anytime you move out on the time frame, you go from a 15-minute to a 60. The 60-minute chart, the levels there, trend lines, support levels give precedence. You move out to the daily chart, that takes precedence over, all the developments in the levels take precedence over the 60-minute charts, and of course on the weekly as well. So I won't do a full rehash of what's going on, other than we had some pretty bearish candles last week, and pretty clear sell signals. They were, at first a little bit in question, the fact that the sell signals came first on the FOMC announcement and that noise, and then of course we had the back test, and that coincided with Trump's tweets. But now we can see that clearly they have played out. That was just the catalyst we needed to break these trend lines and to get the breakdown in XLK, the tech sector. And so I wanted to cover the levels. These are the same levels I believe have been on this chart for a very long time now. These levels down here are, if you're new to my analysis, I've covered these in the past. These are color coded appropriately. If and when we get down to these levels, and I don't expect it to happen today, tomorrow, it could happen soon. Think about stocks as they fall a lot faster than they rise. But we're, right now it's more of a matter of where's the first bounce going to come from. We always have, if you look at any of these corrections in the past, or just about any correction, you always get an initial leg down, and at some point you get kickback rallies. So two things to that. Number one is we know that's coming, and I say this often. If you're a swing trader, or you're new to investing, new to trading, and you want to know, oh man, wow, I've got some very fast profits, and that's why I love shorting stocks. They tend to fall a lot faster than they rise, so you can make in just a few days what can take weeks or even months to make, trading the indexes or a particular stock long. However, they also, when you're in a downtrend mode, everything's in fast forward, if you will. So the snapback rallies come fast, and everything else. Now, where I wanted to go with this is, if you are not an active nimble trader, if you're a typical swing trader, I'll say this: don't be overly concerned with the trying to game bounces, quick reversals off support levels. Try to capture the bulk of a trend. And what I'll say from that is, the corrections, anything is possible, but corrections typically don't end like this, looking like this. In fact, I would implore you to try to go back on the charts in time and look at a drop that was this impulsive with this volume, that came not just randomly out of the middle of nowhere on some bad news event, but technically based. In other words, you usually get at least, even if you're you believe basic Elliott wave is most corrective waves, if you just want to say this is a correction in an ongoing market, they come in a ABC pattern. That's a A down, B up, C down. And so point being is there's most likely more to come to the downside. And so, for a swing trader trying to capture the bulk of the trend, it's certainly prudent at this point. If you shorted here in the wedge or on the breakdown, anytime, there were several opportunities last week to break down the back test, which so far proved to be the golden entry right there when we were back testing. Then you just lower your stops to protect profits. There's a big old gap. So let's just talk about where we might bounce, and then where, if we don't bounce at those levels, what does that mean? Well, number one, it tells me I like to assess a sell-off as it goes, or a rally. In a correction, if you just cut through support levels like they're not even there or hardly there, with a minimal reaction. Remember, we had some levels we hit Friday. We did bounce off them, but it was a very muted bounce. We held, pretty much traded above them all day, had a little bounce, and then the downtrend resumed today with a gap down. So that's impulsive. That means, the buyers, if I was a bull, they'll play that game, and I thought this market was going much higher this year, I would have certainly stepped in and bought 185.70. That's, why not? That's for a long position for the next leg up. It's a pretty key level, very well defined. SPY also had some support, but we sliced right through it. So the dip buyers there got hurt. Dip buyers have been getting hurt all along the way, and that's the nature of any correction. By the time they realize, hey, it's not working anymore, you get that kind of capitulation. So what I wanted to do in this video is lay out the levels, and same levels, these have been on the chart for a long time. And so that's where we're at now. We're at a level right now, call that 182. Remember that when volatility's high, it's almost, the odds favor that you'll undercut on the way down when you have a waterfall sell-off. I call it a momentum-fueled overshoot. The odds favor you're going to undercut that level. So let's just see how we act around it. If we keep going through, we've already had a little bit of reaction here. Let's zoom down to the 1 minute chart. So here's right now, you can see we kind of hit it, and the momentum to the downside has slowed. You had the big gap today, boom, and then we've been stair-stepping levels. So right around that 182. So far, the market is having a reaction there. I define a reaction as a pause and or consolidation or a bounce. Could be either one. So far, because when you're heading straight down, if you stop on something for a while, that's a reaction, or if you bounce, that's a reaction. So far, we've have an intraday reaction there, but the buyers aren't stepping in. But we are at support. So I'm doing this video to show you levels that if you are considering you want to book profits, number one, well, that's objective. Or you want to know how to, let's say you don't want to use a wide stop. You don't want to give back a lot. An objective stop now would be somewhere just above the top of today's gap. Look at Friday's candle, the bottom of Friday's candle, put a stop above there. Because if we bounce up, and that would be a bounce target if we hold here, to come and try to backfill that gap. But let's say you don't want to give that much of a gap up, but you want to let your winners run. It's very simple, and this is what I like to do. I have TVIX, all these other things, SQQ and IRAs accounts, NQ. Set a trailing stop. Now, I'll say this: to how far do you give it on a trailing stop? Well, that's all depends on how much profits you want to risk giving back. I can say this: if you set a very tight stop in QQQ, too tight, these little back and forths are going to take you out. So at this point, for example, you don't want to see QQQ enter the gap. You're also in a downtrend. So if you want to, protect profits on this support level you think we might bounce, set a relatively tight stop. Here's a cluster of candles, maybe there. You can set it, 5-10 cents, but remember, it's also relative to the share price. QQQ is about $181. So 5 cents is you're talking fractions of a percent, basis points. You might want to, think in terms of a little bit wider stop, and then that will prevent you from getting stopped out in the noise. And if this market, all of a sudden just dumps, and it can happen, and the only time you get those waterfall, big drops that can just keep going like this, is after when we have what we call a one-sided trade, and that is certainly what we had. Everybody had given up, a lot of people thinking the market would never go down, especially when the Fed all of a sudden started, just going into full-blown dove mode recently. Oh, well, the Fed's got our back forever. The market, they're never going to let this market drop. Okay, and that's exactly when the last long buys their last share, the last short covers. And I'm speaking metaphorically, of course, but that's tends to be what happens. And when you have a one-sided trade, you have no buyers left because they're all in, and you have a lot of shorts that are now ready to get in because they'd already been squeezed out. You don't have a lot of short interest, so that's where all this quick drops. That's where they come from when you get these quick moves down. You had it here, and again we're having it here. So the rest of the video, just going to spend looking at levels. And then what I like to do is when I'm going over levels on the markets, we're going to just do the major indexes. I'll cover the small caps too, and then some of the market leading stocks. And what I like to do is look for a confluence of support levels. So not just one index, but multiple indexes, especially both SPY and QQQ, as well as the market leading stocks. Because I'll say this, let's just say that the support on QQQ was down here at 180 right now. We're at 182, but so we are at support. But let's say we're at 180, and I looked at SPY, and SPY was also about another percent or so below. And I looked at Apple and Facebook and Amazon; they were all about 1% to the downside. When you have these strong sell-offs, I can tell you this from experience, technical analysis shines. Right now, fundamental analysis has just gone out the door. fund managers, professionals, as well as retail traders get in panic mode, and all they have to cling to are the charts. And so therefore, those levels, if you're falling, you get close to a support level, it's likely to get hit when you get close enough. It's like a magnet or a black hole. You get sucked in, hit that level. Doesn't mean we have to bounce off it, but you know, the odds favor. The more oversold you get, the more stretched the rubber band, at least in the near term, the higher the chances for a snapback rally. So there it is. Let's just run through those levels. So I'm showing you QQQ at support. If it breaks, I don't see a lot of decent support until about 178, and that's a pretty decent. That's a 4-point drop. You know, almost 200 point security. So that'd be a little less than 2%. Yeah, a little less than 2% there. SPY would be at, I have a support zone, and again, these were posted this morning. So far, we pretty much came about the middle of that support zone. That's still where we're trading right now. So no reversal yet in the market, but we do have a decent support zone. In that level, it's been there for a long time, but there's reactions along the way. We had a reaction high here, just levels that the SPY has behaved off of, and you know, had an impulsive drop once it broke there. There was this little, you know, topping pattern here. It was resistance before, it was a previous reaction high, and then we broke out and then failed that breakout, just like this. I mean, exactly like this. I've been talking for weeks now about this breakout to new highs. Remember, we took out that high, previous high here, and there was that period of you know, where we consolidated and we broke out, and then the breakout failed, bearish. Same exact thing happened here. That was this back then. We had a previous reaction high. We tried to break it, failed. Tried again, finally got it, and as I said back then, breakouts, I put odds favored that that breakout would fail because we had negative divergence and we were overbought. Same exact technical posture here. And there's the failure. That means failed breakout, aka bull trap. All those that bought the breakout to new highs, thinking the Fed, you know, would keep this market going up forever, have now been trapped in. So I'll show you some scenarios. You know, if we get the bounce soon, I think it's coming from these levels. If we come up here, a back test of this trend line and or the gap. So somewhere in there would be a target bounce area. You see the bottom of the gap, the top of the gap, I should say, Friday's lows, and that trend line, they come in around together. And to try to tell you where that would be from here, we're trading right here at the bottom of that red candle. That would take us up somewhere, give or take, about a 1. Oh, no, let me put that back there. It depends where we come in at. Let's say about a 1.4, caught about a 1.5 to maybe 2% kickback rally. That's what I could see now is an objective level to get out if you're playing a bounce here, if it starts to materialize. And on that, there's a couple ways, as I mentioned on the front page today. You know, you can take a shot at support with a stop not too far below, or you can wait for a decent evidence of a reversal. We don't see that yet. There's nothing in the charts. What does that mean? You can home down to a 60-minute or even get a little tighter, a 15-minute, 5-minute chart, and look for something like a bullish engulfing candle, big green candle that engulfs several candles. Follow up. Selling climaxes are always something you want to look for, and the more buy signals that you can put together, the better the chance that you're going to have a bounce. So again, first, support. That's something you want to see. The market's at support, especially here on the daily chart. We are not, you know, for a trend reversal, for me to get out of shorts and go long for a swing trade that would last days or weeks or even months, I'd want to see bullish divergence on the 60-minute chart. That's not always required, but I can tell you very few corrections end like this. Usually you get divergence at least on one of the indicators, RSI, PPO, for the major trend reversals. So I want to be very clear. I remain and have, you know, for a long time, longer term, intermediate term bearish, and still think we're going to go down at some point this year, probably this year, possibly early next year, but I think this year, and undercut those lows back from December. But that's longer term. Right now, let's just look at where we could reverse here, where you might want to, you know, lighten up some exposure or trail stops down. So that's support there on SPY. Now let's go through some of the top components of the NASDAQ 100 and the S&P 500. Microsoft. I have a trend line here, potential trend line, and it also comes in at support. 130.46 is a pretty decent support. I've had this level on my chart for a while. We had Microsoft had tried several times and finally broke out above it. So it would be back testing that breakout, that 130, 50-ish support there. A potential trend line, potential because we don't yet have a third reaction, but I just added that trend line today. If that goes, then I don't see a whole lot of support to down here, as you can see, about 123. So that's how this works. I can't tell you for sure, but I believe we'll bounce off there, get a decent tradable bounce, and then at some point another leg down. Apple broke trend there, failed breakout right there on the earnings day, but you can see it's coming up on support. 192.72 is my next support, very close to it. Not a super well-defined level, and there's also a reaction low there which Apple hit today. And again, you have to take all these together collectively. They're not all going to hit support at the same time, but the more support levels you have on these market-leading stocks, the bigger the chance is that buy programs are going to step in, and buyers, whether they're humans or computers, are going to step in and buy. 1752 or so. Amazon coming up on support, not too far from it. Next one, Alphabet. About 160 right there. See that previous reaction high, reaction low right here, reaction high. That's a pretty good level. I see a lot of reactions on that line. So here's one coming up to support. If it breaks through there, you have trend line support a little below that you want to watch. That's the other share class there. Facebook, there's a line I had here. Let me turn it back on. That is at about 182. And there's a gap right there, some reactions, and some reactions here, reactions there, and a gap there as well, and some reactions as well. So again, the posture of these charts tell me, this is just, I'm doing this video because to me, unless anything changes, it's just a matter of when do we bounce, how far is a bounce, and when do I look to recycle back in if I try to game a bounce long or lighten up short exposure. Where do I look to add that back as an active trader? IRA long-term accounts, it's all looking good, just and especially for non-active traders, just sit tight. Obviously with stops in place, because anything's possible. That's possible. I really don't think that's going to happen, but it is possible. So this is what we're looking at on Facebook. Again, we had the divergent high, and those are some levels there to watch. Cisco, won't go through each and every one of these. That line should probably be moved. You can see we had some levels there. That's not. Let's look at another one here. Let's look at Intel. Ooh, ugly. Semis are ugly. I'll get to, well, let's just do that now. Let's look at XLK. I don't see any support there for Intel, not a lot. XLK is coming up on support. In fact, I should have a line there. We had a previous reaction high right here. Let's put our line around that level and then take that line and maybe come in a little tighter and look at the more recent reactions. I always give a little bit higher weighting to the more recent reactions than the previous ones. So we had a reaction low right here, reaction high right there, a little shy of there, so give or take. It's a little more downside on XLK, but again, we had the broad market at support right now and several stocks. And then finally, you can look at some of the top components of SPY that aren't in XLK, I'm sorry, in QQQ, such as JP Morgan. Financials don't, QQQ doesn't hold any financial stocks, so you have JP Morgan as one of the top components in the S&P 500. Potential trend line support right there. Potential again because we need to get a reversal. In fact, you know what? Let me do this. Let me grab that trend line and bring it in here. If I do that, yeah, it looks like we've sliced through that. That's not very good, but I have more reactions there. We'll give it what I call it a BOD, or benefit of the doubt trend line. That's how I might have had that trend line before, but I'm going to put it here. That's actually where I started in the video, because we have a reaction low there, reaction low, and if we can get a bounce here, that'll give us a third reaction and validate that trend line. But again, that's near term, smaller picture, maybe a bounce up to that 112.50-ish level, and then go on break down. Why? Because again, divergent high right here leading up to that high, big correction. Divergent high, big correction. Divergent high. This divergence tells me that this is not it, that more is to come. Maybe a bounce off support, maybe another leg up, maybe not. But I see more downside in the coming weeks to possibly months here in JP Morgan. just near term, you get stretched, the rubber band gets stretched, and you snap back. So that's it. Let's see. I'll cover one more in the financials. Credit services. This is Visa because it's one of the top components of the S&P 500. Well, I had that wedge like that. We'll just leave it the way I had it. Breakdown and back test, and that's it. So it's playing. The technicals are playing out. The divergences, as they almost always do, play out. Sometimes you just diverge for a while, that low volatility, until you get a sell signal. And in this case, it was a breakdown back test and finally impulsive rejection. So Visa has a little way to go, and so there may be a little more downside in the market. That's pretty solid support. It's a support zone that runs from about 168.18 to 165.70. But again, if the majority of stocks and or the indexes hit support and they bounce, Visa's probably not going to make it there. But if it does, and let's say it falls that level and the stock S&P 500 or QQQ or a lot of the top components are at support or slightly below at the same time, there's a chance for a reversal. And then likewise, if you want to know, when the next leg down is coming, that's when those levels go. So the ideal scenario, have something like Visa come here, consolidate, bounce, work off the near-term oversold conditions, and then break down along with the market indexes and other stocks as well for the next leg down to swing that, down here to about that 157 target. And that's it. Not much else to add. Those are levels I watch. I'm watching. And as of now, again, the market's, all day, or not all day, but most of the morning since it hit that level, it's been holding there. So at least we've stabilized now. So again, lots of ways to play it as an active trader. Being that we've stabilized, if you want to reverse, cover some shorts, or at least tighten stops down very tight at this point. And or go long for a bounce. If you're going to go long for a bounce trade, you just maybe consider a stop below the recent lows or even tighter than that. It depends on what you want to do. We don't have buy signals yet, but we're certainly having a reaction here on this support level. So that's why you can put a relatively tight stop. I mean, even if you bought right now and you put a stop below today's lows, you're talking 0.5%. That's 0.5% down to today's lows. So it's an attractive RR for an active trader. Take a bounce trade to try to get a gap backfill. There's I wouldn't go for all the, well, yeah, you could certainly shoot for the top of the gap, but here's some resistance around 186.25. So that would give you alone a 2% upside with a 0.5% downside. That's a 4-to-1 risk reward. If you're shooting all the way for the gap, and I'm doing the math, but there's a pop-up box on the bottom. It shows the percentage. That's about a 2.7% rally to backfill the gap from here. Again, with a stop a little bit below, 0.5% downside. So pretty attractive risk-reward ratios for an active trader. And you can also look then to one of two things if you're going to do that. If you're going to do this, active trading thing, get in. If it starts to pan out, then what you do is you just ratchet the stops up along the way. Your initial stop is here. When you start to see some volume come in, we start to move up. Then go to your break-even point. Set your stop at break-even when we're here. In other words, ratchet the stops. You can use a broker, have a thing called a trailing stop loss order that will automatically ratchet up. Because I'm an active trader, I like to manually raise my stops, just kind of watching as things go on. But that's what I'm looking to do today, is to stops on some positions, especially the IRA stuff, longer term accounts. I just set stop losses. If we start to reverse and bounce up, book some quick profit. Those will take profits, but if we take another leg down, they'll stay short. And then the active trading account, I've covered and reverse that to a long for the video, because we're at those supports on the daily chart where, again, bounce is likely, and even if not, the downside's minimal if we bust on down through there and head to the next level. All right, let's wrap it up here so I can get it out to you guys, and of course I'll do a follow-up video, either another one before the market closes today, or at the very least an end-of-day market wrap. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.